Hi, everyone. I'm Jeff Cullen, CEO of Strategic Retirement Partners, and welcome to our Q4 2022 SRP Market Insights. I am joined today by our Chief Investment Officer, Robert Wagner, and a fellow investment geek and member of our asset allocation team and investment committee, along with me. So, Bob, let's go ahead and get going here. Let's talk about what's going on in the markets.
All right. Well, this chart we used last quarter didn't change it much this time because there's been not a whole lot has changed on it. The war in the Ukraine is continuing to go on. What's kind of interesting here is we have Tiger. The part of this that's kind of interesting is Taiwan, because we just recently had an election over in communist China. So I would imagine the entrenchment of the power of Chairman Xi, his concern with Taiwan, that's probably going to be leading the headlines in the near future, I would imagine. This year's an election year. We certainly have had our volatility. There's still that fear of new COVID variants. I know that they're locking down some areas out over in China. And so that's always a persistent concern. However, here in the U.S., we have a better vaccine and we're farther along the curve than China is. But those, a new variant can always jump up and complicate the supply chain. Some parts of the supply chain have gotten better. Some have gotten worse. They took out the Nord Stream. And so there's a whole, that's once again, that still continues to be a concern for the markets. The other thing is the Fed has been accelerating rates. We've had some hikes of 75 basis points. Looking forward, we've probably going to have another 75 basis point hike, followed by either a half or another 75 by the end of the year. There's unrest around the world. The only thing I changed here was that we added Iran. There's some unrest in Iran. You could probably add Germany to this list as well. And we haven't gotten to the winter yet. So depending on how things turn out this winter and the energy and food issue in Europe and the rest of the world, this unrest could grow. Now, put all this in context, though, we have a relatively good economy going right now. We have relatively low unemployment. The household balance sheets are in good shape. And we had a decent GDP number today. So, put all this in that context. What are the tailwinds? Well, I just said one of them was the economy seems to be holding up pretty well. As far as the vaccinations, we're doing good with the vaccinations. We're getting towards herd immunity. Consumer spending has been resilient. Like I said, the GDP number came out today that was pretty solid. Cash reserves on the sideline are elevated. We've had 3 down quarters in a row as far as the equity markets go. So bottom line is we're closer to the bottom than we would have been. However, that's not saying much. We still need to have some kind of a catalyst to turn this around. One good thing, though, is the market tends to look 6 months out in advance. And so what we're looking for is we're looking for the market to sniff out that interest rates have peaked, that inflation has peaked, and a lot of times after the midterm cycle of a presidential cycle, the markets tend to do better. So there's a couple things on the horizon that could start to get us a little bit bullish, but we have to wait to see how is the market going to be reacting to these Fed rate hikes. Jeff, you got anything to add to that?
No, let's dive into the CPI here on the next slide. So this is the makeup of the CPI. So you see the largest portion goes to housing. One of the issues with that particular thing is it's done with what's called owner's equivalent rent. And if you think about the way rents work, approximately 1/12 of all leases in the country would expire each month. So if there's been an appreciation in the value of the property, you're only going to see 1/12 of those leases go up with each month as those leases mature. So what can happen is that the way we report inflation in housing, it can have what's called a lag, where it takes a while for it to show up in inflation, how much home prices have actually been going up, which leads to inflation being too low if prices are going up quickly, too low in the beginning, and then once prices stop going up and they're just catching up as leases expire, inflation looks significantly higher than what is actually taking place in the economy. So it's this constant lagging effect. We've seen some of that here recently. and we're likely to see it on a go-forward basis, where we might see that print of CPI in the housing area be higher than it actually is in real life because of that lag. And so it's just trying to keep that CPI number in context, in proper context, because of how it's calculated.
Yeah. Now, we always look at it as far as when we take a look at the CPI, we look at basically two components. You have the sticky part and you have the transient part. What I like to look at it is we have the inflation sensitive and the non-inflation sensitive. So when we're taking a look at, the whole purpose of the Fed raising rates is to slow down inflation, to slow down growth, which translates into slower inflation. Raising the interest rates is going to hit the housing area pretty bad, right? But it doesn't necessarily hit the food and energy, and that's the complication that the Fed's facing right now. Because what we like to say is that the Fed is trying to fight a supply side issue with demand side tools. So when they increase interest rates, they can slow down the housing, but they can't bring more food and energy to the markets, and that's the complicating factor of what's being creating so much volatility and uncertainty in the markets right now.
Yeah, and just to be clear so what we mean by demand side tools is that with the lever of interest rates, what the Fed can do is increase demand in the economy or shrink demand in the economy. So if interest rates go down, people spend more money. If interest rates go up, people spend less money. And so what they're really using that as a lever to do is control the demand. And I'm sure, as everybody has figured out by now, what we're experiencing in the food and energy areas has nothing to do with demand. It has to do with a lack of supply. So that's what Bob is referring to, is the incompatibility between trying to shrink or increase demand when really the problem here is a supply issue. If you increase interest rates, it doesn't make more oil magically pop out of the ground. And so that's really the problem that we're having here, is really the Fed's not designed to fix this kind of problem. So our anticipation is that the problem will persist as long as the problem is going to persist, until we get some better policy that would help us solve some of these issues. That comes from Congress. That does not come from the Fed. So so the Fed is probably fighting a battle that it's not designed to fix, and we're just along for the ride and trying to anticipate what sort of goofy problems they may get us into.
Okay, now this is where a large amount of the pain comes from. Now what we have here is we have a chart of inflation and earnings. So as you can kind of see, inflation has been picking up, whereas earnings growth has been going down. And so when you see here, we have inflation of over 6.5, you have wage growth of around 4. And what that means is that your real wages have actually decreased. And what I like to say to describe this is you're getting paid more, but you can buy less. So when you go to the grocery store, you're simply buying less goods and services, even though your wages have gone higher. Now, what does that mean? I mean, how does that, that sets off what I call is a very vicious cycle of inflation. And
up in the upper left-hand corner, to Bob's point, you can see that because the weekly real earnings, so real earnings means inflation adjusted earnings. So you can see that the average person there in the upper left-hand corner has less money to spend on goods and services than what they had prior to Q1 of 2021. So as you might expect, in the bottom left, the savings rate has gone down. In the bottom right, the amount of credit card debt has been exploding, and the time at which savings rates started going down and when credit cards started to explode concurs almost exactly with when real earnings went negative. So these charts really just show what the American public and American workers are going through right now, and that there's a fight for wallet share, and unfortunately savings and increasing credit card balances are losing that battle.
Yeah, and just to put some numbers to that, Jeff, you can kind of see here that at the bottom of the global financial crisis, mortgages were around $600 a month. During the COVID era, mortgages were around $1,000 a month. Currently, the peak is around $1,816 a month for your mortgage. So we've basically tripled since the global financial crisis, almost doubled since COVID. And then if you take a look at student loan debt, back in 2007, it was around 30.7% of your income. Now it's up to 53.8. And so what that's doing is, as you can see, this is really squeezing the households. And as you pointed out, if you're a person that's working paycheck to paycheck, you're either digging into your savings if you have them, or if not, you're running up your credit card debt, and that's tacking on another 13 or 14, 15% to the already inflationary environment. So you can really see there's this can do a real number on households out there, and that's why the need to get inflation under control is so important.
Yeah, and Bob, one more thing. There was a chart that we did not include on that prior page, and what it was is it was a chart on the median monthly mortgage payment that Americans have, and the great financial crisis of 2008, that number went up to $1,200. So to put it into context, the housing bubble and the economy fell apart when mortgages got to $1,200 the last time, and we've blown right through that number all the way to $1,800 in the current environment. So definitely, to put things in perspective, to show the pinch that people are in, that's a really good representation of where people are at.
All right, you want to take this one?
Sure. We for many years. For those of us that are in the business, we listen to the soothsayers at the Fed as if they are demigods of some kind, or that they go back to their dark rooms with their oracles to figure this stuff out. When in actuality, what history shows is all they really do is chase the market. So what you're seeing here in the light blue line is the U.S. Treasury rate of the 2-year bond. And you can see that all the Fed really does is just slowly, after the fact, chase and trace where the 2-year return goes. So the good news is that they aren't just pulling these numbers out of a hat, that they actually are trying to chase something, because I think it would be a little bit scarier if they weren't following the markets. I think the bad news is that today the 2-year is sitting at a rate that is about a full % higher than where the Fed funds rate is now, which would imply that if history repeats itself, the Fed is going to continue increasing rates to try to catch up to that number.
Yeah, let's put some actual numbers to that. Here's the actual yield curve. This is I updated on 10/17 when we made this, and as you can kind of see, this is basically what's done the damage this year. This is the yield curve. Over here we have the yields. Down here we have the maturities. Now this is what's called the back or long end of the yield curve. This area is determined by the market. It's determined upon economic growth and inflation expectations. This is called the front or short end of the yield curve. This is controlled largely by the Federal Reserve. You have low interest rate sensitivity here. You have high interest rate sensitivity here. And what's happened over the years, we've had this parallel yield curve shift. Now, as you know, as interest rates rise, bond prices fall. So, I call this basically a no place to hide market. This yield curve shifting took down the equity markets and it took down the bond markets. Right now, is what Jeff was just pointing out, is the Fed tends to follow the 2-year. Well, the 2-year is all the way up here at 4.45. Right now, this is the current as 3 and 3.25. The next rate hike is expected to take it up to 3.75. So as you can kind of see, we're creeping our way up in this direction. So that's where we're headed. Now, what does that mean for the investor? Well, what we typically are watching for is we're waiting for the market to give a signal that interest rates have peaked or the inflation has peaked. Because what's happening now is the Fed is raising rates to calm down inflation. Once they calm down inflation, the market can build some optimism about where it's going. It needs to have some certainty. So what we're watching closely now is as the Fed raises rates, and it's expected to be up here by the end of mid-December. What we do is when they raise the Fed rate, we watch this long end to see if it shifts down. because once it shifts down and does the opposite of what the Fed's doing, that's a good signal that the rate cycle may be coming to an end. Markets tend to like that. If the markets anticipate that interest rates are peaking, they're also anticipating inflation is peaking. Markets tend to like that. And then, of course, we have the post-midterm election coming up, which could also be bullish or bearish. Either way, it's probably going to bring certainty to the market, and that typically would be good. So, just a quick recap here is the impact of rising rates. It hurts bond prices. It slows economic growth, which is what the Fed's trying to do right now. It increases the cost of borrowing, which is, your credit card. And like we talked about, a large number of people are using credit cards to buy food and energy, which can really, that's like getting yourself in a hole and asking for a bigger shovel. And then, the higher mortgage rates. One of the big things about the higher mortgage rates is that it slows down the housing market. And what's important about the housing market is you're not only hurting the housing market, there's a magnifier of about 9 to 1 as far as job dependency. So when you raise mortgage rates, you slow housing, but then you also slow the purchases of appliances, slow the purchases of glass, you slow the purchases of your furniture, you hire fewer lawyers, you hire fewer realtors. So there's a tremendous overflow that when you slow housing, it also slows many other areas of the economy as well.
So I think one thing that needs to be pointed out, though, is we probably have still quite a ways to go economically before we are out of the woods on this one. But if the stock market was a baseball game, right around the conclusion of the third inning in an economic downturn is when the stock market bottoms and starts to go back up. So even if we anticipate that, that things are going to get worse before they get better, that doesn't mean that just because that's happening in the economy, that's what will happen in the stock market. Because the stock market is forward looking, it frequently, and as I said, usually it's right around the conclusion of the third inning or 1/3 of the way through a downturn when it bottoms out and starts to rebound. So we don't know how close we are to the end of the third inning, but we're probably closer to that point than we are further away. We've already been in this downturn now in the market for about 9 months, and we're probably getting pretty close to that inflection point. So we'll continue to monitor this stuff. As always, dollar cost averaging in is still your best bet inside of a 401k, because you don't want to miss out on being able to pick up stocks at a less expensive price. And as always, only take the risks that you're comfortable taking.
Yeah, and that's a really good point there, Jeff. I'll make one last little comment. There's one of the things we always watch for as a bullish sign is when the market rallies on really bad news. That's one more little signal that we're watching for, combined with the watching for the peaks of the inflation and interest rates. All right.
Thanks, everyone.
Thanks, everybody.